morning, everybody. It's Steve Brown from Mirae Asset Securities. Joining us this morning, we have Mr. Alex Crane, the Managing Director of Knight Frank, and also Ben Gray, Director of Capital Markets for Knight Frank. Gentlemen, thank you for being on Mirae Asset.
Thank you. Thanks, mate. Cheers.
Yep. Now, 1896, 55 Baker Street, Knight Frank established operations. Today, approaching 15,000 staff worldwide. You've got about 11 years experience in Vietnam, Alex, and you've got about 8-9 years this year as well, Ben. Both appointed and welcome to establish the Vietnam operations. So I'll dive straight into a follow-on to that. Why set up the consultancy now?
Thank you. Well, I think, look, we had been working on this with Knight Frank for some time. So, as you know, I was running another consultancy here prior to, but Knight Frank were a partner. So while they didn't have an office here, they would send a lot of business in. So this could be investors, could be multinational companies. So we saw the volumes and demand from the company. They saw the same, and obviously we have that conversation. Now, we're probably a little bit behind where we wanted to be, because obviously the last couple of years of pandemic sort of may have slowed us down a little bit, but it didn't alter our sort of excitement, I guess, to actually establish the business here. And the rebound, as you know, we've seen in Vietnam, has sort of supported us in that decision. So we formally opened in February this year. Quickly established our team. You know, being here a long time, being able to bring in partners like Ben and other staff and a lot of clients gave us a lot of confidence, coupled with obviously the Knight Frank network, which is very strong. You know, they're the largest privately owned real estate company in the world. So they take a pretty holistic but aggressive and quick approach sometimes when making decisions, which is very different to some of the other more corporate agencies out there. So that's something culturally we really liked, but I think is the right sort of business and approach for a market like Vietnam, where you have to be nimble, entrepreneurial. You have to roll with the punches a little bit sometimes too. And that's the sort of business that really interested in me. And I think enables us just to be a bit more dynamic in the market. And we saw a little bit of a gap for a higher quality of service level, which Knight Frank are known for, being very prominent in sort of luxury, high-end residential. They're very famous for, but that also applies to our very big corporate business, which is as big as the residential side. So if we can apply that here, then I think we're on a pretty good footing.
And the machinations that have been going on since your recent establishment in Vietnam and globally, post Q1 with the increasing interest rates in the US, which has flowed through to increasing interest rates here. We've had a few logistics supply chain bottlenecks as well.
It's a polite way to put it.
Yeah.
A few small bottlenecks, right?
Yes. So why should you think investors should look at Vietnam? And I'll take you through the tiers there. If we start our capital markets expert with the infrastructure, logistics side of town,
sure,
and then segue into commercial, corporate office and resi as well.
Okay, I think, look, the most common question I get asked is sort of why Vietnam versus, say, you know, Bangkok, for example, or maybe a Malaysia, or going a bit further south, Indonesia, etc. And the most simple answer we've got from me since I first got here 8 years ago is that from a regulatory and legislation framework, this country's always moved forward and never gone backwards. We always seem to be improving what we've got. And then if you look at sort of the general macro factors of Vietnam, you know, we've got a GDP of 270-odd billion, sorry, get that number right, not in VND now. And then you look to something like Bangkok, which is 500 billion plus. Thailand, I should say, in general. And you kind of imagine the size of the two countries, you know, 100+ million over here, 100+ million over there. How much room have we got to grow in the next 10 years to be able to match the nearest market to us up here, if you like? So the growth story is absolutely fantastic. And that's before you get into the current snapshot for things like GDP growth globally. You know, we're over 7% projected for the end of the year. You know, we've got very strong fiscal and monetary policy over here. You know, we are sort of a command central economy. There's a lot of levers that can be pulled by the State Bank of Vietnam. And even, I think it was the beginning of the week, the Financial Times in London ran a piece which basically stated success story globally, Vietnam. And that's for different factors that perhaps some of the mature markets don't like. You know, the actual political and economic system over here does seem to work. And in terms of what people can get out of this coming out of the COVID situation, you know, the biggest pickup which I see happening moving into sort of the core industrial space is China. China, unfortunately, is going through a bit of a tough time, to be very polite about it again. And you compare the way the government here reacted to COVID, our ability to get through it and come out of it, all guns blazing. And now we start to see the pickup from other regional markets with investors starting to look in. Twin on top of that, again, the real drive from the government here to invest heavily into infrastructure. And we start to see a good picture going forward for the next 3 to 5 years.
Alex?
I think I'll leave that with Ben. I mean, in terms of, yeah.
So for new investors to get into the market, I'll throw that one to you.
Yeah, so I mean, I guess two purest forms of indirect and direct investment. Indirect, I guess, which would be, I guess, for your clientele and your listeners and watchers, maybe the most favourable. So, we've looked at the growth of firms like Ving Group with their Vin Homes real estate operating company. Novaland have been performing very well in recent years. Those companies also have made vast steps in the governance and the sophistication, particularly in the last 5-6 years. Very impressive steps. KDH is another PDR, Nam Long, which if you're looking into more sort of residential and township. So those are probably the key ones. And again, they're all hitting a level that looks a little bit more international standard in terms of how the government plays, how they operate, and the sort of assets that they're putting together. So those, we like the story behind a lot of those groups. Many, particularly Asian groups, have come in direct. Again, over the last few years, co-investing has probably been the most favorable in terms of coming in with groups that have access to land bank and pipeline. So we've seen huge investments from the likes of Keppel Land, Singapore, Lotte. Obviously, again, Korean sector into Vietnam is phenomenal. So Lotte have been here for a very long time. Hong Kong groups, and it'd be interesting to see how they perform in the next year or so, with the likes of Hong Kong Land being here for quite a while. Swire came in very recently, have been quite successful. Again, looking at more project level acquisitions or investments that are coming out very well indeed. Industrial space has been a very hot one for the sort of, say, 4 years that market's really started to develop. So Gore, again, from Hong Kong have come in. Indochina Capital, local group, have partnered with Kojima out of Japan, putting together a very nice platform with Core 5, who are the US entity. So they're bringing an awful lot of capability and experience, which I think the market really needs and has benefited from. When we get that sort of doubling down effect of confidence, I think when we're starting to see sophisticated money bringing capability and expertise into some sectors that really needed it. As I said, the Vietnamese groups are getting much more sophisticated in terms of their delivery, but partnering with the foreign groups has been able to accelerate a few of those and just give them even more scale. And we didn't even mention Warburg Pincus and what they've done in the industrial segment, but also early days into Vin retail and more recently into lodges, into hospitality.
And a lot of those are also combining the service and support proposition in industrial parks. They're also now having integrated long-term service departments for some of the foreign experts and senior management who live in and work in the industrial park zones as well. Right. You mentioned Warburg Pincus and lodges. There are people involved with that who are co-investing in those projects for the accommodation service sector of those industrial park precincts. And then also, you mentioned before about the large investors who've initially come in perhaps on their own, but now they're collaborating and co-investing, such as Keppel has been joined by Gore, being joined by Swire for the second phase of the Empire.
The local fund.
Which
is also part of your development on this building.
Yep.
So,
was sold out.
But again, another sort of group that maybe not the biggest name, but has got a good track record and sort of does attract that international capital. Just touching on that FDI and the numbers coming in, we had a quick look because looking at numbers year on year at the moment with what's happened with the pandemic, geopolitical issues going on. So we just wanted to take a look at 19, which I guess was the last normal kind of year. And FDI into real estate, 9 months of this year is about 3.5 billion, represents about 13% of all FDI into Vietnam. Compare that with 2019, it was about 1.7 billion. So tracking over the last 2 years, we've sort of bubbled along, but if you compare it to that last sort of open year, if you like, the sector's looking pretty good, as are the general FDI numbers into Vietnam.
Yeah, well, that's the surprising thing. And even the performance of the listed real estate sector last year still held its own relative to the listed performance of the bank sector. You know, so it's kind of one of those situations. A lot of investors out there don't really appreciate the performance and the attractiveness of the market, you know, so whether it be for the local investors or whether it be for the FDI investors and the co-investors or doing their own project by project investing. So what are they looking at, the investors?
I think the main themes we're seeing coming through are really sort of twinned around this sort of manufacturing base coming out of China, logistics, 3PL, light manufacturing, heavy manufacturing. So, you know, the big, large ticket investors coming through, backing groups like, you know, Logos, Yishang Redwoods, Emergent Capital, Indochina Kojima with Creed, is it, or Core 5? Core 5. I always get those ones mixed up. You know, these guys have got the very simple rationale or thesis that these groups will start relocating out of China en masse. And we're starting to see it already with support for Apple products, for example, without naming too many of the Taiwanese groups coming through. I'm not talking sort of, you know, your Pegatron size, you know, billion-dollar investments, but more a group that approached me last week and said we need 30,000 square meters because we make the wire that goes into the Apple headphones. I was like, okay, that's a very small widget, but they need 30,000 square meters, and they've identified Vietnam as going to be the place they want to build this for the next 20 odd years. So that's fantastic. So very much, you know, groups coming through targeting that industrial space. They've been here for a while. You know, we're looking at sort of 4 years worth of this type of investment. And one thing I will say about the industrial sector in general is these groups coming through, this is almost first cycle. So prior to that, we did have large IP developers like VS IP, etc. You know, the big sort of JVs coming through and building out IPs. But traditionally, if you wanted to, you know, build your factory over here, you had to buy the land. So we now ended up in a position where groups are coming through and doing ready-built factories, ready-built warehouses, build-to-suit, etc., retaining that ownership, building the portfolios up with the intent to list in a few years. So you look at the monsters like BWID over here, again, Warburg-backed. You know, undoubtedly there's a listing in the offing there at some point in the next 2 to 3 years. You look at some of the aspirations of the other funds coming through, right down to you know, your Viet Capital Logistics Services looking at around 100 million they're trying to get together at the moment. Your Emergent Capital's 250 million pledged to it. I think it's ESR 250 coming through as well. They've all got big plans, and the market is there to be grown into. I think one of the guys from a big fund on The Economist said the other day that it would take, I think it's 2.5 or 3% of Chinese existing manufacturing base to come across to Vietnam to absorb our entire stock. That's it. So if we can see more issues coming out of China and more of these relocations coming through, we've got the big investors now coming in, putting the hard yards in, building the quality kit these guys need. The manufacturers are coming through, the end users are here, and that's pretty much a key tenet for that sector. Outside of that, retail, hospitality, bit of an ugly word in Vietnam, especially in the hospitality hotel sector at the moment. You know, the growth story pre-COVID would have been 18, 19 million foreign arrivals per year versus, again, I always benchmark on Thailand, which is 49 million. So you look at the growth prospects in that sector here, look at our coastline, beautiful, etc. A lot of money plowed into that. A lot of the big groups, your Novalands, your Vin groups, etc., building out large quality kit, big resort developments, etc. That's before we get to second homes. You know, post-COVID now, there's obviously a bit of a drop in terms of international arrivals. I think we had 8 million this year so far. That's probably only going to go for another couple of million towards the end of the year. One of the things people forget out of that sort of 18, 19 million pre-COVID is a lot of those were Chinese arrivals and Russian. So we're stripping out a lot of the foreign arrivals, but we've also got a very large population in Vietnam and an awful lot of wealthy middle-class individuals that want to go on holiday.
The mass affluent, exactly.
Exactly that. And that's the bit of the market that I think a lot of people overlook. So when you look at something like a Nova Land development, for example, going down into Ho Tram, isn't it? Nova World?
Yeah.
Okay, so second homes, service apartments, hotels. That's not catering for you guys flying out of Europe for sitting on a beach. That's catering for our you know, larger burgeoning middle class that now wants to be able to hop in a car and go down to the second home.
Sure, the 8 to 10 million Richmond Cityites who can go on a car ride for a few hours.
That's exactly it. Yeah. And that's the southern bit. You know, you get to the northern bit, we're sort of duplicating the same size, right?
Sure, yeah.
So, you know, there's a large, again, the growth prospect in that sector is fantastic for developers that are reputable, that can actually deliver the product on time and to a quality that's recognized.
So getting back to some of the things that have happened, after Q1, Prime Minister Chin, in a very considered way, curtailed the overexuberance in issuance of corporate bonds, had a bit of a look into the situation. That's now this month led to the rollout of Decree 65 amended for issuance of corporate bonds, which should hopefully then segue into renewed capacity for people to kickstart their developments, their projects, increase investor security as well, and take up of corporate bonds again. Are we in a bubble coming up with that? Because at the moment we're kind of in a deflated situation. Most of the developments are stopped. There's not too much going on. People are kind of moving and getting their JV sorted. There's also recent starts and groundbreakings and ribbon cuttings from Lot A and 2TM here. But what's your take on the situation with the revitalisation initiative of Decree 65 for corporate bonds, particularly for the real estate scene, obviously?
Do you want to say that?
Well, I think, look, yeah, I no doubt you'll expand on this, but again, as Ben said, policy often is written without looking back, you know, and I think something had to happen there just to stabilise that, the bond markets, because there were some, you know, pretty untoward activities happening that we don't need in the sector. So, okay, they did the right thing to maybe just pull that in line a little bit. We've seen Decree 65 happen. We've seen the first bond issuance, you know, announced this week. With Sung Kim Land. So, you know, hopefully we're just seeing that kick off and restart, as you say, in a refreshed manner that ultimately, again, helps investors with the governance and the policy around these groups. What we were sort of, as that was unfolding, looking at, you know, the possible impact on the wider market and those developers. Now, you know, I think the impact would have been on those that were perhaps less well governed and funded. And so every now and again, you do get a shakeout in a market when there's a little downturn, and sometimes that's no bad thing. This is attrition, but what you come out with is companies that are much better funded, much better organised, and are able to continue and deliver asset that we need and product that the country demands.
Sure, and the distribution of the bonds for someone like yourself heading the capital markets part of Knight Frank, potential investors in projects will be getting a bit more comfort if they're from overseas financial backers of a project, to know that the developer and then the other co-investors, if they're using corporate bond issuances to help fund and develop their project and pay for the construction and so on, are doing it in a much more transparent way, I'd imagine.
That's the key thing. And you know, the investors which I talk to in the sort of the cap market space, groundly looking to come in direct to acquire corporate bonds and start to fund these guys if they can't come through with JV pref or straight equity, then that's what they need to see. And to be able to get that, they're working on it. Decree 65 still has a little way to go, I think, before it starts to become very well polished. But to have a lot of the investors I spoke to, and they basically said, you know, crikey, the market stopped. You know, the State Bank of Vietnam said, we will not do this anymore, and it literally stopped. And everyone went, well, how are they going to fund everything? And we said the same thing. This will be a shakeout. You'll start to be able to realize which developers have got the balance sheet strength to be able to continue with their acquisition, acquiring their pipeline, not what's on balance sheet, actually acquiring what they've got coming forward, right? Which a lot of the valuations are baked in around that kind of that concept, forward looking. So we said, look, keep an eye on it. We'll see who goes to the wall, if anyone does. So far, it's been okay. And we said, when it comes back out again, by the end of the year, we'll start to see a cleaner process with greater transparency that can give you confidence coming through with whoever's behind you, individual investor group. You know, what's the color of your money? What's that governance requirement on it? And it will give you the ability to look in and see, okay, project A had a, you know, either corporate bond or project level issuance. That's being used to fund construction or buying it, whatever it's going to be. At least you can see it. Yeah. Not project A is actually funding something 600 miles away, which is currently, or a subsidiary that's somewhere else that's currently buying up a whole.
Getting into an Evergrande kind of.
Yeah, exactly. Yeah, exactly.
We'll actually see it.
Yeah, I mean the Evergrande. That's always the one people have been bringing up recently with us. You know, you look at the way that collapsed so quickly. And in terms of the size of that beast, it dwarfs anything we've got in this market. And I was asked a question on a panel a while ago saying, "What's our next Evergrande?" Is that we haven't got one. To be quite frank, we're okay on that. You know, one thing I'd like to see tidied up here a little bit is how the pre-sales off plan? How are they actually utilized by developers in terms of funding the projects?
Yeah.
Okay, that's something I'd like to see tidied up a little bit in terms of de-risking the market to an extent.
Yeah.
Because again, an investor looking through and you say to them, look, it's great, concrete slab's done, they can draw down up to 10, 15, 20% at the moment, it's almost unlimited. And everyone goes, well, what happens between there and the top of the building?
Yeah.
Well, in theory, it's going to be fine.
And historically, some of the smaller, particularly unlisted developers, they would consolidate, get the land use rights, and then they would start to sell off the plan condos.
Absolutely.
But they would then on the side get a mortgage for the land, so they couldn't deliver the pink book.
Correct.
So hopefully that will also get sorted as well, and then everything will become developed market.
So
standard.
that was an interesting thing with the refresh from Q1 this year, is we started to see a couple of the, I don't want to say where, but the ghost towers. So the original owners of those suddenly started popping up again and saying, actually, now's the time where we can look to consider selling. Yeah. Because we've had to go through a period of pain, usually since about 2018, 2019, a couple of investigations into banks, for example, where they looked at the lending practices and went, well, it's not that great, really. And we're now starting to see some of these projects taken back up again, investors looking aggressively into it. Some very interesting returns on them, as in very, very high. And we're starting to see this product come back forward and these ghost towers will start to disappear, which again is what we need in the market, because nothing looks worse when you stand on top of a building and say, look at the skyline. Well, what's that one? Oh, well, that's the IFC tower, and it's been empty since 2008. So, you know, having that restarted.
And that's a case example now of something that's almost going to be good to go, hopefully toward the end of this year, early next year.
Yeah, looking great. It's
looking good, right?
Yeah, we needed that asset since I arrived. It stopped when I got here, so it's great to see
exactly.
it starting out.
That's one of the first questions I asked in 2013.
Yeah, what's that?
Yeah, when will that be finished?
Yeah, it's going to be a fantastic project.
One day.
Yeah.
Well, at the previous shop we both worked at, I was going through the database and I found the original leasing agreements and marketing particulars from 2009. And I was like, okay, that's going back a little bit of time, isn't it?
Because the foundations, I think, from what I read from our research, were among the best, deepest foundations for an office tower in Ho Chi Minh City, given its proximity to the river and canal. They really poured money into it.
Yeah,
you know, so
literally.
I forget how deep they are, but they are, and it's one of those, and it came from the period of construction where things were generally over-engineered, which is in many ways a reassuring fact, right? So a lot of conversations around the foundations and the structure of that building, but the developer there, you know, a very experienced team, have pulled that together. You know, they're redoing M&E and the facade, and that's starting to look really good. But we always, you know, we looked at the example of Shanghai Tower, which went through a similar thing back in the Asian financial crisis, where the site sat there for the best part of 15 years, foundation, the concrete, that stuff can stand forever. So, you know, having that over-engineering in place back then is a benefit now. But you know, crying out for that asset to finish.
I'll stay on this train of thought. Office. Update on office and your outlook for next year.
Yeah, well, that building is an example. We're crying out for it, and I think you know, the fundamentals of that building, in particular, very good design, and we're really excited to see that coming forward. But that's what the market needs in both Ho Chi Minh and Hanoi. You know, through pandemic, rents are still increasing down to essentially low vacancies, lack of construction. Fortunately, now Ho Chi Minh City is going to be a very exciting time. Particularly, Hanoi also has some wonderful assets being constructed, but Ho Chi Minh has, you know, 4 or 5 A-class projects in the pipeline, which we really need. A lot of the original A-grade assets are now, you know, going back to the 2008, I think was the first, or 90s even, some of them. So they're aging. So we need this asset to come through. Rents are at a pretty stable high. We're comparatively still quite expensive to markets like Thailand, for example, where their inventory is about 6 times the size of Ho Chi Minh and Hanoi. So I think it will, you know, ease some pressure on rents, which is good news for occupiers. That's not to say rents are going to fall. We're not going to be in an oversupply situation, but we're getting some top quality development coming through, which big companies need in these cities.
So we might talk now about the ESG influence coming into the office space and commercial scene. A lot of investors internationally, pension funds and mutual funds, have that as one of their investment checklists to tick off on. And also domestically, this quarter, UOB Asset Management Vietnam are launching their first ESG-focused fund. What's your take on the investor appetite for the building scene commercial and industrial park scene with ESG issues?
I think from the groups I work with looking inbound, bringing capital onshore, it's an absolute key tenet for what they put their money into now, quite simply put. They have to now look at buildings that tick off the environmental for sure and social governance side, absolutely. And that means that we're seeing more of a carrot stroke stick for developers to be able to hit those marks. And, you know, Alex can expand on this quite nicely, but intrinsically as well, having a building that has got the decent quality environmental credentials in terms of the way it's operated and managed has a positive effect on the value. You know, it's cheaper to run and you can usually command a higher rent.
Yeah. I mean, the performance, we put something out recently. I mean, in Ho Chi Minh, we didn't check in Hanoi, but it will be similar. Green buildings with a green accreditation are getting a premium of 18% on average in terms of the rent income. They are also newer, so there is a part to that, but it's a fantastic story. And that's not dissimilar to where this has been in place longer. So in the US, it's sort of 7-8% is a premium for LEED buildings versus non. So it's encouraging to see that performance. And this has only really been happening, you know, I worked on the first LEED building in 2011, that was President Place. It's good that this is actually, you know, getting to the point where it's a must. It's not even a conversation for the developers because investors demand it, also the occupiers. You know, so big multinationals now, there are some in the market today looking for space and they will not look at anything without an accreditation. So also what's going to be interesting as a knock-on effect, as I mentioned, some of these older assets, they're going to have to reposition. We're going to have some adaptive reuse. These are all opportunities for investors to look at reposition capital improvement as a result of some investment into some older projects that need the uplift. They will have to retroactively get a green accreditation if they want to keep the best tenants. If they don't, you know, they're going to suffer for it. So we've used the phrase before, it's survival of the greenest now. It's not part of the conversation. It is the direction the market needs to go in. Yeah,
some of the CBD towers that I've seen revitalize and pretty well strip themselves inside and out. Main Point Tower is one example.
Great job.
Yeah, fantastic job on that. And the rents went from late 30s to early 40s almost overnight.
Yeah.
You know, because again, for you know, the bog standard nuts and bolts underwriting perspective, you've got a green building, it's cheaper to run. You know, if you get the glazing right, it's cheaper to cool. It's cheaper to heat if you're in the UK or anywhere else. So on the simple basics of it, you can run it more efficiently. And those additional OPEX margins get filtered through to the eventual price.
I think something that could come out of this, and I think now the market's showing the momentum and genuine demand. It's not just greenwashing. This is what investors and occupiers want. Yeah. You know, I think there's a burgeoning segment for more green loans in Vietnam. I think HSBC, with them recently, you know, they just happen to be the two best buildings in the country, I think, in terms of Deutsches Haus and Capital Place in Hanoi, both LEED Platinum, I think. So they were doing preferential lending on those on the construction of those projects. So I think the more that can also expand will naturally just encourage, you know, again, more sophistication around the sector, and that's really what we're trying to drive toward. We know the investors will buy it. We know the occupiers will pay a bit more for it. Let's give the assistance to the developers to deliver this.
And that's actually, just to expand on it one last time on the green bit, it really isn't greenwashing. The lending space and the ability for groups to come through IFC backing cheaper loans very simply into developers that can demonstrate on their supply chains the green credentials for each of their products. And so from a developer perspective, tapping into that cheaper capital, obviously, you know, it's a no-brainer.
Okay. Now, the recent round of credit tightening, impact on investors, how do you see it?
In Vietnam, interesting, is a polite way to put that. So in terms of sort of the dramatic stop we saw at the start of the year, that stopped all developers going forward, quite simply, because they had, at one point, we were told facilities that developers are unable to draw down on, because they said, look, we're going to have to wait and see what happens. So there was a dramatic ceasing to exist of all projects going forward. It stopped. In terms of what's rolled out since then, we've seen the market kind of recover. Developers have gone out and looked at alternative funding structures they can tap into. The simplest being, right, we're going to form a JV. Right, it's going to come through, bring in a big chunk of equity and get the projects rolling that way. Or they've looked to the private credit space and they've been able to tap into that locally, as well as looking overseas to an extent. So the tightening we saw had a very short, sharp shock, but then the market, I would say, very quickly recovered, and developers are still moving forward. And what happens in the next 6 months, now we've got, I think it's Article 65 coming through, that's going to be quite interesting to see if we can recapture that domestic corporate bond market as it relates to real estate.
Yeah, listen, pre-COVID was a huge slice of the lending environment, the debt capital market through bond issuance.
Yeah, I mean, it was absolutely enormous. It was 60 odd billion US dollars. I mean, it's completely bonkers. And the reason I say it's completely bonkers was that lack of transparency into it. And, you know, I hate to use the word Ponzi scheme, but there was a couple of less reputable groups out there that were borrowing from Peter to pay Paul, quite simply. And, you know, whilst that's great when the music's going, when it starts to slow or stop, then you start to see these companies start to wobble. So again, by the very dramatic action that was taken at the start of the year, and again, the view from investors coming through initially was like, blimey, that's a bit crazy. What's going to happen next? Short, sharp shock, stop, regroup, and now we're moving forward again.
Sure, yeah. So the things from here moving forward, we've got Decree 65 starting to roll out. Anything else you'd like to see to improve the investability of the real estate space?
For my little sort of part of the market in terms of raising capital for groups, specifically around sort of private credit, I'd like to see some more improved regulation, I think, and legislation around the taking of security. And I don't mean by share pledges or anything like that. What I mean in terms of actually mortgages, bog standard, there's a piece of dirt, how do we actually give that to a lender? Because at the moment, the part of the market that is shut down for Vietnamese developers onshore is the ability to tap into that private credit for mezz or bridge sub 12 months. You know, it's not cheap, but a lot of developers around the world will utilize that sort of bridge finance section for their end construction costs or whatever else. It's a very key part of the finance. So it'd be a great move by the state to effectively put in some regulations to allow foreign investors to take charge, take mortgage. Yeah. Over physical assets, immovable assets, to be quite clear on that.
Exactly.
Immovable.
I agree.
Yeah.
So, Alex, outlook for the next 12 to 24 months for Vietnam first, and then for you, Ben.
Yeah, I mean, I guess I'll talk point to point on assets, and I guess what we're seeing from an occupier standpoint was often the view I take, some on the investors. But if we go through asset classes, I don't think there's any that are going to keep us awake at night for the next 24 months. As you said, there's maybe some pressure to come through the residential development sector, but the fundamentals of the residential market are good. We looked at the population of both cities hasn't really fluctuated through COVID, so we haven't seen that disurbanization. I guess we're still getting that net positive urbanization, which drives a lot of the residential markets. Remittances are still very strong from overseas Vietnamese that funds a lot of the residential markets. I think there's going to be, again, flight to quality for assets from certain investors. That also ties into some of the ESG that might be applied into that specific sector. Commercial markets are robust. The office markets we've touched on, very solid. Industrial, we haven't spoken about much, but that's probably the one that I think has a little bit of an unspoken concern, which is that price point has got to the land pricing has got pretty toppy. Construction costs in the meantime are going up. What investors got wrong in some areas, if we were looking at the e-commerce boom pre-COVID, and then we saw this spike in e-commerce sales and everyone piled in thinking that would continue forever. It didn't. We got back to the office, we got back out to the shops, and that just sort of plateaued out. So, that what we thought was a big drive into industrial and logistics hasn't, or is not going to continue at the same rate. You apply that into the logistics occupiers, the big three PLs. These guys work on very fine margins. So rents are not going to increase at the same rate land pricing and construction is. So there's going to be a little bit of pain in there for some that have maybe not got their feasibilities quite right. We've mentioned a lot of groups that are looking at these international platforms. I think there's going to be one or two that aren't going to scale up to the extent maybe they thought they would. That will create M&A opportunities between those groups. It will create a more sophisticated market in terms of the quality of asset and ultimately growth for what is a very important sector in Vietnam. But again, we've got the tailwind of manufacturing growth story here. So the fundamentals there are still very good. I think there's just valuations need to be written with two eyes open in some cases. We compare, actually, while we're on this, the warehousing market, the growth of that is also accelerating. So I think on a compounded basis, the market here is growing at about 16% per year in terms of floor area being built. tracking Thailand, it's about 3% a year. So we might be in a little bit of an oversupply situation of warehousing next year. That rent pressure might hit one or two of these investors. It'll be more of a tenant market. Ultimately, that's not a bad thing. But I think there's some valuations might need to be corrected in that area. But otherwise, retail, again, on the consumer markets that are driving the same in hospitality, we've been pleasantly surprised. And again, it wasn't people staying on online shopping. People are going back to the big malls. And what we've seen equally is neighborhood retail performing very, very well, as we all got used to being in our little areas through lockdown. The sort of neighborhood street scene has sort of improved. So the performance there has sort of surprised us a little bit. There's always, a repositioning needed for historic retail assets, but Vietnam isn't overly exposed to old assets. So I think a lot of the new stuff that's coming through is going to be well positioned for the future retail trends. So we're quite big on that at the moment. And I guess, as I said, I'm not losing any sleep on any particular market. I think there's little items within segments that investors just need to be aware of and making sure they're doing their homework, not only on the partners, but actually what the story on the ground is with the actual occupier demand or buyer demand if we're talking residential schemes.
I'm also very sort of, I think, bullish, actually more so than I would have been, pre some of the global headwinds we're seeing at the moment, to be quite frank. I think we are in a very unique sort of goldfish bowl or bubble in Vietnam in terms of, from the macro perspective all the way down to the granular. If you're looking at, like I said at the start of the opening conversation, what we look like fundamentally, it's a good place to be. In the region and globally, our growth prospects are fantastic. As that comes down into different aspects and asset classes within real estate, sure, there's some concerns around, interest rates going through the roof, inflation going through the roof, etc. You talk to some of the large industrial developers and the ones that are quite open and frank, they say, look, we're going to take a haircut. But at the end of the day, when we put this product back out to market, if we go through, say, a listing opportunity or we try and sell it, we're still looking at yields of 8-9%. And you look at the way these yields can compress in industrial, for example, when you benchmark against China, where we're seeing 5.5-6% for similar product. So again, growth prospect on that. Residential-wise, again, when it comes down to it for people buying apartments, it's sub 15% of all sales are done with retail mortgage. That's something that the government, the State Bank of Vietnam, wants to grow into. But at the same time, it means that if interest rates go through the roof, we're not going to see the market fall over. So again, these little sort of tweaks within the market that a lot of investors, perhaps your investors looking into it, might go, well, they're quite unique for this market compared to other regional peers. And that's one of the reasons why I think that we're going to see something quite positive over the next at least 12 months, even more so with the regional headwinds and pressures we're seeing.
And you're right, there's still a lot of maturation in the market to go in many sectors. The first-time buyers, not many still take mortgages, even though they're increasing at an exponential rate.
Correct. Yeah.
So if there is an increase in the 10-year bond yield, they can still absorb.
Yeah, absolutely. And an interesting one with that. So I was speaking to one of the investor developers over here, and I said, look, the Vietnamese government's just moved us up by 100 basis points. The guy went, and 4.5%, 5.5%, 2.5%, 3.5% on refi. And he said, well, yeah, but if we walk into a bank, we still are borrowing between 10 and 12% in VND. It's not moved the needle. Yeah. Which is an interesting thing, again, when you look at that in our market in London, etc., then that's a big move, and groups would have gone to the wall with that. And we're having some big pressures in the UK at the moment. And that's one thing I'd like to sort of leave that comment on. The VND USD peg. As I pointed out to someone this morning, in the last 10 days, £1 million house in the UK is 20% cheaper for me because I'm long USD. I don't think the VND's depreciated against the dollar more than about 2.5% in the last 12 months. Yeah. And the State Bank of Vietnam's got over 100 billion of firepower to maintain that peg. So you start to look at it from an investor perspective. With each of the different asset classes, we've got some very unique points that should be understood in their way that they're positive. And then we've got some interesting things as well in terms of the way the economy is managed, in terms of our FX exposure. And again, compared to some of our peers that don't have some of those levers to pull, we are very positive going forward. And again, fastest growing economy at the end of this year, apparently.
Gentlemen, thank you very much again for being on Mirae Asset Securities, Mirae Asset Live. Alex Crane, the Managing Director, and Ben Gray, the Director of Capital Markets. Steve Brown, Head of Institutional Sales for Mirae Asset Securities. Have a good morning.